Warren Buffett, the world's greatest investor. If you enjoy the content, please consider subscribing and liking the video. It truly helps the channel grow. It is August 30th, 1930, in Omaha, Nebraska. The Great Depression is beginning to tighten its grip on the United States. Banks are failing, people are losing jobs, and fear is in the air. In a small hospital in this Midwestern city, a boy is born to Howard and Layla Buffett. They name him Warren Edward Buffett. His father, Howard, is a stockbroker who will later become a U.S. congressman. His mother, Layla, runs the home with a strict sense of discipline. Money is tight. Sometimes food is rationed. The family sells household items to get by. But even as a child, Warren is surrounded by the language of finance. He hears his father talk about stocks, markets, and clients. Numbers and prices are not distant abstractions. They are part of what keeps the lights on. From an early age, Warren shows two traits that will shape his life: an obsession with numbers and a hunger to experiment in business. At 6 years old, he buys 6 packs of Coca-Cola from his grandfather's grocery store and sells the bottles door to door for a small profit. He keeps track of his earnings carefully in a notebook. He delivers newspapers, sells magazines, collects and redeems used golf balls, and installs pinball machines in barbershops with a friend. Each small venture teaches him something: how to handle customers, how to judge demand, how to think about cost versus price. At 11, he makes his first stock purchase. In 1942, he buys 3 shares of Citi Service Preferred at $38 each, one for himself and two for his sister Doris. The stock drops to $27, and Warren feels the sting of loss. He holds on. Eventually, the price rises to $40, and he sells, pleased with his small profit, until he watches the stock climb to $200 not long afterward. The experience sears a lesson into his mind. Impatience can be costly, and selling as soon as you are slightly ahead may not be wise if the business itself has long-term strength. Buffett's childhood is not just about money. When Warren is a teenager, his father is elected to Congress, and the family moves to Washington, D.C. Warren, however, misses Omaha. He attends Woodrow Wilson High School, where he runs a profitable newspaper route and files meticulous tax returns, even deducting his bicycle as a business expense. He buys a used pinball machine and sets it up in a barber shop. The idea grows into a small network of machines before he and his partners sell the business. By the time he finishes high school, he has saved thousands of dollars. Impressive at any time, remarkable in the 1940s. He wants to skip college and go straight into business, believing he already understands enough. His father insists he get a degree. Warren reluctantly agrees. He begins at the University of Pennsylvania's Wharton School, then transfers back to the University of Nebraska-Lincoln, where he can live more cheaply and work as he studies. He graduates at 19 with a degree in business administration. At this point, Buffett discovers the writer who will permanently shape his investing philosophy, Benjamin Graham. Graham, a professor at Columbia Business School and a practicing investor, has written Security Analysis and Intelligent Investor, books that argue for value investing, the idea that stocks are pieces of businesses, and that investors should patiently buy companies selling for less than their true worth. Buffett reads Graham's work again and again, underlining passages, copying formulas, and feeling as though a language he half knew is suddenly becoming clear. He applies to Columbia so he can study directly under Graham. At first, he is rejected, but he writes a letter explaining how much Graham's ideas mean to him. The school reconsiders, and Buffett is accepted. In New York, he attends Graham's classes and sits close to the front, absorbing every word. Graham is cautious, rational, and focused on numbers. He teaches that investors should buy stocks only when they trade well below the value of the underlying business, creating a margin of safety. Buffett excels in the program and, after graduating, asks Graham for a job at his investment firm. Graham initially declines, telling Warren to go back to Omaha and do something else. Buffett does return to Omaha and sell securities for a time, but when Graham Newman Corporation eventually offers him a position in 1954, he moves back to New York in a heartbeat. Working for Graham is like being in a practical advanced school. Buffett spends his days analyzing companies, searching for underpriced stocks that meet strict quantitative criteria. He learns discipline, patience, and the importance of avoiding emotional decisions. Yet he also begins to see that Graham's method, while effective, sometimes treats companies as numbers on a page rather than as living businesses. Buffett is curious about the people who run these firms, the quality of their products, and their long-term potential. In 1956, Graham decides to retire and close his firm. Buffett, now 25, returns to Omaha and starts his own investment partnership. He chooses a simple structure. He will manage money for family and close friends, investing alongside them. He takes no management fee, only a share of any gains above a certain threshold. The partnership begins with just over $100,000 under management. Buffett's approach is careful but aggressive where he sees opportunity. He invests in cigar butts, companies so cheap that they still offer a few puffs of value left, even if they are not great businesses. He also engages in special situations, such as mergers and restructurings, where he believes he can predict outcomes with high probability. His letters to partners are plain spoken, filled with examples, and obsessed with performance measured against the Dow Jones Industrial Average. The results are spectacular. Over the next several years, Buffett's partnership compounds at a rate far above the market. As word spreads, more investors join. The young man from Omaha, who still drives himself to work and lives modestly, is quietly building one of the best track records in investing history. During this period, he discovers a struggling New England textile mill called Berkshire Hathaway. The business is simple. It makes fabric. The industry is shrinking, but the company's stock is extraordinarily cheap relative to its working capital and assets. Buffett begins buying shares in the early 1960s, initially as a temporary value play. A dispute with management over a tender offer irritates him. Instead of selling and moving on, he buys more shares, eventually gaining control of the company in 1965. Owning Berkshire will become one of Buffett's defining moves, but not because of textiles. In fact, the textile operations will continue to struggle, and he will eventually shut them down. The real value of Berkshire Hathaway is as a corporate shell, a legal structure in which he can reinvest the company's cash flows into better businesses. Berkshire becomes his permanent investment vehicle. Around the same time, Buffett's approach to investing evolves, influenced in part by his longtime business partner, Charlie Munger, an attorney and investor he met in 1959. Munger urges Buffett to look beyond cigar butts and instead buy excellent companies at fair prices, not just fair companies at cheap prices. This shift is crucial. It leads Buffett to seek businesses with durable competitive advantages, what he will later call economic moats. One of the best examples of this new thinking is his investment in See's Candies. In 1972, Berkshire buys the California-based candy company for about $25 million, a price that feels high based on its tangible assets. But See's has something special: strong brand loyalty, the ability to raise prices without losing customers, and a culture of quality. Over the decades, See's will generate far more in cash for Berkshire than its purchase price, while requiring relatively little additional capital. It becomes a legendary case study in the power of buying a wonderful business and holding it. As the 1970s and 1980s progress, Berkshire Hathaway grows through a combination of stock investments and outright acquisitions. Buffett buys large stakes in companies like American Express, Geico, and the Washington Post when they're temporarily out of favor but still fundamentally strong. He forms close relationships with capable managers like Katharine Graham of the Washington Post and Jack Byrne of Geico, offering advice but not interference. He believes in giving good managers a long leash while holding them to high standards of integrity and performance. In 1979, Buffett appears on the Forbes list of the richest Americans for the first time, with an estimated net worth of $140 million. He still lives in the same Omaha house he bought in 1958, a comfortable but unpretentious home on Farnham Street. He drives his own car, eats at local diners, and prefers Coca-Cola and cheeseburgers to fine wine and gourmet cuisine. His lifestyle becomes part of his legend, the billionaire next door who still enjoys simple pleasures. Throughout the 1980s, Berkshire's share price climbs as its underlying businesses grow. Buffett writes an annual letter to shareholders that becomes required reading not just for investors, but for anyone interested in business and clear thinking. In these letters, he explains concepts such as intrinsic value, float, and the importance of understanding the difference between price and value. He uses humor and analogies, comparing the stock market to a voting machine in the short run but a weighing machine in the long run. He warns against speculation, leverage, and trying to time the market. Not everything is smooth. In the late 1980s, Berkshire invests heavily in Salomon Incorporated, a large Wall Street firm. Buffett respects Salomon's leaders and believes the bond trading house is undervalued. But in 1991, A scandal erupts when it is discovered that a Salomon trader repeatedly violated Treasury auction rules. The firm faces the possibility of being banned from buying U.S. government securities, which would be a near-death sentence. Buffett steps in as interim chairman to help rescue the company. In congressional testimony, he apologizes for the firm's behavior and pledges that Salomon will adopt the highest ethical standards. He famously tells employees that they must lose money for the firm before they lose a shred of reputation. Through intense negotiations with the Treasury Department, he manages to keep Salomon alive, but the episode is stressful and costly, both financially and emotionally. It reinforces for Buffett the importance of integrity and the dangers of associating with businesses whose culture is weak. Meanwhile, Berkshire continues to expand its core operations. It buys insurance companies such as National Indemnity and General Re, utility businesses, and manufacturing firms. Insurance becomes a key engine of growth. When an insurance company collects premiums, it holds money float until it must pay claims. If managed wisely, this float can be invested profitably. Buffett views float as a low-cost or even negative-cost source of capital that he could deploy into stocks and acquisitions. By the late 1990s, Buffett has become widely known as the Oracle of Omaha, admired for his track record and plain-spoken wisdom. Yet during the dot-com boom, he finds himself out of step with the market. He avoids most technology stocks because he says he does not understand their long-term economics well enough to estimate their intrinsic value. As internet companies soar in price, some critics claim that Buffett is out of date. He shrugs and sticks to his principles, reminding shareholders that he would rather be approximately right than precisely wrong. When the tech bubble bursts in 2000, many of the companies that had been market darlings collapse. Berkshire, which had not joined the frenzy, holds up relatively well. Buffett's patience is vindicated. The episode becomes another example of his willingness to withstand periods of underperformance rather than chase trends he does not fully understand. In the early 2000s, Buffett makes several notable moves. He increases Berkshire's international exposure and buys more capital-intensive businesses such as utilities and railroads, recognizing that these regulated industries can provide steady, long-term returns. In 2006, Berkshire announces the acquisition of a major stake in the Israeli company Iskar, signaling Buffett's comfort with investing beyond U.S. borders when he finds businesses that fit his criteria. Buffett also begins to talk more publicly about his plans for philanthropy. For years, he has said that he does not intend to leave most of his wealth to his children, believing that too much money can be a burden rather than a blessing. In 2006, he announces that he will gradually give away the vast majority of his fortune, primarily through foundations started by Bill and Melinda Gates and by members of his own family. This pledge will eventually become part of a broader initiative called the Giving Pledge, in which billionaires commit to donating at least half of their wealth to charitable causes. Then comes the global financial crisis of 2008 to 2009. As banks and markets convulse, Buffett's calm presence becomes a source of reassurance for many investors. Berkshire deploys capital when others are fearful, injecting money into firms such as Goldman Sachs and General Electric through preferred stock deals that carry high interest and additional rights. These investments, made at a time of great uncertainty, later yield substantial profits. In his letters, Buffett reminds readers of his long-standing advice: be fearful when others are greedy, and greedy when others are fearful. At the same time, he does not ignore the seriousness of the crisis. He acknowledges that mistakes were made across the financial system, including by rating agencies, regulators, and executives. He calls derivatives financial weapons of mass destruction when used irresponsibly, and he emphasizes the importance of strong capital and prudent risk management. As the years pass, Berkshire Hathaway becomes a conglomerate unlike any other. It owns outright companies as varied as Geico, Dairy Queen, BNSF Railway, Benjamin Moore, and Fruit of the Loom. It holds large stakes in publicly traded giants such as Coca-Cola, American Express, and later Apple. Each year, tens of thousands of shareholders travel to Omaha for the company's annual meeting, which takes on the atmosphere of a festival, often called Woodstock for capitalists. Everywhere, people wear shirts with Buffett's face, buy products from Berkshire subsidiaries, and gather in a sports arena to hear Buffett and Munger answer questions for hours. Buffett's public persona is a mix of modesty and showmanship. He loves simple jokes, uses cartoons in annual reports, and plays the ukulele. He drinks cherry Coke on stage and jokes about his diet of hamburgers and ice cream, calling himself a one-quarter Coca-Cola. But beneath the folksy image is a razor-sharp mind that reads obsessively analyzes businesses with precision, and maintains discipline in both booms and busts. He emphasizes a few core principles over and over. Invest in what you understand. Buy businesses with durable competitive advantages. Back honest and capable management. Avoid excessive debt. Be patient. And remember that the stock market is there to serve you, not instruct you. He distinguishes between investing and speculation, arguing that true investing is about evaluating businesses, not guessing about short-term price moves. As he moves into his 80s and 90s, succession becomes a more pressing topic. Buffett and Munger assure shareholders that they have identified internal managers who can take over key roles. They begin to give more public visibility to executives such as Ajit Jain, who oversees insurance operations, and Greg Abel, who leads Berkshire's non-insurance businesses. In 2021, Buffett signals that Greg Abel is the likely successor as CEO when the time comes. Even while planning for the future, Buffett continues to adapt. In the mid-2010s, Berkshire builds a significant stake in Apple, a company that Buffett once avoided as a tech firm but later comes to see as a consumer products powerhouse with strong ecosystem and loyal customers. The investment, guided by one of his investment lieutenants and endorsed by Buffett, becomes one of Berkshire's most lucrative positions. Through all of this, Buffett's personal life remains grounded in Omaha. His first wife, Susan, is a major influence on his worldview, especially in matters of social justice and philanthropy. Their marriage is unconventional. They separate but remain close, and after Susan's death, Buffett marries Astrid Minks. He stays connected to his three children and encourages them to pursue their own paths rather than follow directly in his footsteps. If you were to film Warren Buffett's life like a documentary, much of it would not look dramatic in the Hollywood sense. There are no wild car chases or sudden plot twists. Instead, the tension comes from a quieter place, the challenge of staying rational when others panic, the discipline of saying no to investments that don't fit even when they are fashionable, the slow build of compounding returns over decades. You would see a boy counting pennies from soda sales, a young man hunched over annual reports late into the night, a middle-aged investor calmly reading while markets roar around him, an older man stepping onto a stage in Omaha to speak to shareholders who hang on his every word. You would see the same modest house, the same city streets, the same simple office on Farnham Street. The scenery does not change much, but the numbers, the value of Berkshire, the size of his philanthropy, the reach of his ideas grow enormously. Buffett often describes his own journey with humility. He says he is lucky to have been born in a time and place where his particular talents, understanding businesses and allocating capital, are highly rewarded. He notes that if he had been born in another era, his skills might have been far less useful. Yet luck alone does not explain his record. His consistency, willingness to learn, and emotional stability set him apart. He also warns against copying him blindly. He encourages individuals to invest in low-cost index funds if they do not have the time or interest to study businesses. In his will, he directs that a large portion of his personal estate for his wife be placed in an S&P 500 index fund, a simple strategy he believes will serve most people better than trying to pick stocks. In the end, Warren Buffett's life story is about more than money. It is about the power of patience in a world that constantly demands speed, about the value of clear thinking in a noisy environment, and about how a person can live simply even while managing enormous wealth. He shows that great investing is not a mysterious art reserved for a chosen few, but a discipline built on common sense, restraint, and a deep respect for the businesses that underpin the numbers on a screen. If you picture him today, an elderly man with glasses, gentle voice, and a Coca-Cola in hand, sitting in his office surrounded by books and reports, the scene might look ordinary. But as with one of his favorite analogies, the weighing machine of history reveals something else, a life that turned a modest start into a compounding force, not only in dollars, but in ideas about how to invest, how to lead, and how to give back.